Today I would like to analyze AT&T, one of the largest telecommunication company in the world. This company was one of the worst performing stocks for many years. We can see here in the 5-year charts we are down close to 35%, but then this company made an incredible comeback and is up close to 100% from this time. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 198.67 billion US dollar. This makes AT&T the third largest telecommunication company by the market cap. We also have a dividend yield of around 4.02%, which we can see here was very inconsistent in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 143 billion US dollar. This was a strong decrease around 21% from 2019, so probably related to COVID. In 2021, we saw again the decrease around 6.3%. This is something we really don't like to see. In 2022, it got even worse with a decrease around 10%. And then finally in 2023, we saw the comeback with a growth around 1.4%. And in 2024, we saw the 0.07% decrease. So overall, I think in the last 5 years, the revenue growth was very bad. It was a very bad performance, and not a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 28.4 billion US dollar. So this was a 2% decrease from 2019. Then we saw the decrease again around 7% in 2021. And in 2022, we saw the very high decrease around 53%. And then finally in 2023, we saw the comeback with a growth around 65%. And in 2024, we saw the decrease again around 10%. So this free cash flow is also very inconsistent, and we don't like to see the free cash flow decline in so many years. So it's not a check here as well. If we take a look at the operating cash flow, we can see it also decreased 3 years in a row since 2020, but we saw some increase in 2023 and also in 2024. So the difference is that in 2024, we saw the free cash flow decline. So the main reason for that is in 2024, we saw the capital expenditure rising around 2 billion US dollar. This means the company invested more money into the business. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, around 19.49 billion US dollar. We're going to divide it with the current market cap, 198.67 billion. Then we're going to get the free cash flow yield around 9.81%. So I think this is a very high free cash flow yield. So we like to see that, and this could be an indication for undervaluation right now. But I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 17.85 billion US dollar, in 2026 around 17.34 billion US dollar, and in 2027 around 18.28 billion US dollar. So I'm not sure if these numbers are realistic. So let's assume for 2027 18.3 billion US dollar. Let me know in the comment section if you think this number is realistic. Then we're going to divide it with the current market cap, 198.67 billion. So then we would get a free cash flow yield for 2027. So this would be a free cash flow decline over the years. So the number we're going to get would be around 9.21%. So again, this is a high free cash flow yield as well, even if we have the free cash flow decline in 2027. So I think this still can be an indication that this company could be undervalued right now. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. This is a very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. This is around 118 billion US dollar. We're going to add the short-term debt as well. So the short-term debt is here around 4.9 billion. Then we're going to divide it with the current free cash flow, 19.49 billion. So then we're going to get the debt to free cash flow ratio for 2024. This is around 6.3. So I think this number is not very good. It's over 5, so we don't like to see that. This means the company can repay the debt with the free cash flow in over 6 years. So we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 3.3 billion US dollar. And I also think this is not a very high amount. So overall, I think this company doesn't have a great balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So first we're going to calculate the enterprise valuation. This is the current market cap, 198.67 billion. We're going to add the debt, 122.9 billion. We're going to take minus the cash. The cash is around 3.3 billion. So then we're going to get the enterprise valuation, how much the whole company is worth. This is around 380.27 billion. This now we're going to divide with the current free cash flow, 19.49 billion. So then we're going to get the enterprise valuation to free cash flow ratio for 2024. So the number we're going to get would be around 16.33. So I think this is a great number. This can be an indication for undervaluation is under 25, and this would be a check here. We can also calculate this number for 2027 with the free cash flow assumptions around 18.3 billion. Then we would get a different number. So the number we're going to get would be around 17.39. So this is still a great number, I would say, but we can also see this company would become more expensive already if the free cash flow decrease in the future. And I think if the company can continue to decrease the free cash flow, this would look even worse in the future. So we need to assume as well that this company can increase at some point the free cash flow. This would be something important as well. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially we think the company is undervalued. But I also think this company has not a very good balance sheet. So I think it doesn't really make sense for them to buy back their own shares. So we can see here in 2020, they bought back a lot of shares. So they used around 5.5 billion US dollar for that. But since then, we can see the money they used for the stock buybacks decreased. So in 2020 was nearly 1 billion US dollar, but in the other years it was closer to 200 million US dollar. So I think this is a check here, because we also don't like to see this company buying back a lot of their shares because they don't have the financial to do that. I would like to give my conclusion about this company, so let's start with a positive. So the free cash flow yield around 9.81% is looking quite good. This could be an indication for undervaluation. But we also assume that the free cash flow would decrease in the future. This number in 2027 could be around 9.21%. So it would look slightly worse. The enterprise valuation to free cash flow ratio is also looking quite good with around 16.33. But again, with our assumptions for 2027, this number would look slightly worse, around 17.39. The balance sheet is also not looking good. We have a little bit too much debt and not much cash on hand. So this is something we don't really like to see. The bad revenue growth in the last 5 years is also something we don't like to see. We saw the decrease in many years in a row as well. And the bad free cash flow growth is also something we don't like to see. So I think this company does look undervalued in some perspective, but we don't like to see that the revenue is decreasing and the free cash flow decreasing as well is, for me, something we don't really like to see. And I think this company could be a hold right now or fair valued, but I would not really recommend buying into this company right now until we see some good revenue growth or some good free cash flow growth again in the future. If you found this video helpful, don't forget to like and comment and subscribe for more content.